very warm welcome to all of you. I hope you and your loved ones are safe and maintaining good health. Today, I'm going to share with you some key highlights of a recent CRISIL rating study on the outlook for credit growth in the Indian banking sector. Now, bank credit is seen growing 15% per annum in FY23 and FY24, riding on broad-based economic recovery and stronger, cleaner balance sheets that allow lenders to expand credit. This estimate factors an expected 7% increase in GDP this fiscal, as well as impetus to credit growth from the government's infrastructure push, higher working capital demand in a high inflation environment, and some substitution of debt capital market borrowing. While GDP growth could see some moderation next fiscal, that would be on a higher base, thereby having limited impact on credit demand. The segmental composition of credit growth is likely to be different though. While this fiscal is likely to be driven more by the retail and MSME segments, corporate credit could be a large contributor next fiscal. Retail credit is expected to grow the fastest this fiscal at 17 to 19%. Demand for home loans, the largest subsegment, should stay robust despite rising interest rates and real estate prices, as affordability remains better than in the past. Unsecured retail loans, which were muted during the pandemic, have started to grow again, as this remains a lucrative segment for banks. While credit growth in FY23 to date has printed higher, the second half should see this moderate somewhat and touch 15% levels for the full fiscal, given the base effect of rapid growth in the second half of FY22. In fact, in FY22, over 90% of the incremental credit was added in the second half of the year. What will be a key monitorable in this high credit growth environment is whether deposit growth can keep pace. In fact, with competition from deposits also set to intensify, some banks may have to resort to higher cost wholesale deposits, which may impinge on their margins. So, profitability for the sector this fiscal should still be higher than last fiscal, given the favorable impact on net interest margins in a rising interest rate environment. And on that note, I thank you for your time and attention. Until we meet again with another topical theme, goodbye.